Hey everyone, welcome to this explainer. If you've ever looked at the financial markets and thought, man, why do so many people just walk away completely empty-handed? Well, you are in the exact right place. Today, we're breaking down the defining difference between those who survive and those who get wiped out.
Here's the wild truth. 90% of traders fail. And listen, it's not because of strategy, but because of poor risk management. It's not the fancy trading system that breaks them. It's literally their inability to manage their downside.
You see, most beginners focus on making money fast. They're always hunting for that one massive home run trade, right? But professionals focus on protecting capital. Think about it. If you don't have any money left to play with, you're out of the game entirely.
Section 1. The brutal math of losing. Why big losses destroy accounts.
So here's why that matters. Say you lose 50% of your account. Human intuition kind of tells us, okay, I just need a 50% gain to get back to where I started. But because your account size is now cut in half, you actually need 100% profit just to recover. You have to literally double your remaining money just to break even. That's why big losses destroy traders.
And honestly, the damage isn't just mathematical, it's deeply psychological too. Risking too much creates fear, greed, and emotional trading. When that panic sets in, you end up trading out of this desperate need to make that money back, and poof, all logic goes straight out the window.
Section 2. The casino mindset. Thinking like the house.
Professional traders think like casinos. They know they won't win every trade, but they manage risk so they can survive long term. They just accept small losses as the cost of doing business. That way, a losing streak won't ever destroy their account.
So how do they actually do that? Well, if you risk only 1% per trade, a losing streak simply won't destroy your account. Even if you lose 10 times in a row, you still have the vast majority of your capital perfectly intact to keep playing the game when the odds inevitably swing back in your favor.
Section 3. The 3 golden rules. Your survival framework.
All right, here are the 3 golden rules you need to know. First, never risk more than 1% on a trade. Second, always use a stop loss. That's a hard, predefined boundary that automatically gets you out of a bad trade before it turns into a total disaster. And third, target at least a 2-to-1 reward-to-risk ratio.
Let's actually drill down into that 2-to-1 ratio for a second. Basically, this means for every single dollar you risk losing, you must be targeting at least $2 in potential profit. If you stick to this, you could actually lose more than half of your trades and still be profitable at the end of the month. It completely removes the pressure of needing to be right all the time.
Section 4, discipline over gambling, the path to consistency.
I want you to honestly reflect on your own habits for a moment. Are you trading or are you just gambling? Because if you don't use a stop loss and you're risking large, random chunks of your account, well, you aren't trading. You're just playing against the house, hoping to get lucky.
Trading is not gambling. It's discipline, patience, and consistency. That successful 10% we talked about earlier, they aren't thrill seekers. They patiently wait for the right setups and consistently apply their rules, trade after trade.
If you want to stop gambling, start managing your risk like a casino and truly master capital preservation. Follow for more trading and gold market content. I'll leave you with this one final thought. If your trading strategy requires you to be right all the time just to survive, are you actually an investor or are you just rolling the dice? See you next time.